As if investors don't have enough on their plates right now, Russia injected fresh volatility last week as they officially began military operations in Ukraine. Now, before investors panic too much, I want to address 3 questions to determine the ramifications for the U.S. economy, and then very importantly, the long-term direction of stock prices because of this. First, I think it's important to note that the impact of what we call geopolitical events like this on the S&P 500, they've been relatively temporary and trivial through history. Since Pearl Harbor, the average drawdown of geopolitical events on the S&P 500, it was 4.6%, not much at all. And the average recovery took a mere 43 days. Now, if we look at it a little bit differently, we can look at what's called the median recovery. And that removes the effects of what we call extreme outliers. And that recovery took 18 days. So the first question to ask is this time any different? And before I answer that, I want to provide a little bit of context on the current crisis we're seeing. You see, Russia, they've been fighting in this region for well over a decade. Putin, he began with Georgia back in 2008. And then in 2014, he annexed Crimea, and here we are today. Furthermore, the question refers to how long the market's really going to pay attention to this, not necessarily how long the conflict's going to last. And you don't have to be an expert in geopolitics to answer this one. Back in 2014, if you recall, we talked about Crimea. As this conflict was going on between Russia and the Ukraine at that time, and it worsened to the point where a civilian passenger flight was shot down, and it killed 300 people. Now, here's the thing. Not even that was enough to keep traders focused to disrupt the market. So for this current crisis to impact the stock market for more than a few weeks, the story that we're looking at has to keep going and keep getting bigger and scarier and worse. Now, there's 2 ways that the media is currently trying to, I guess you'd say, scratch this itch. And it's by suggesting that, one, any success by Putin is going to incentivize China to invade Taiwan, or that this will ignite another world war. Now, regarding the first point, while Russia and Ukraine are mostly isolated from the U.S., the fact is Taiwan is critically important because they manufacture over 50% of the semiconductors that go into everything from cars to missiles. So this, if takeover happened from China to Taiwan, this would almost certainly provoke a response that involves more than just what we'd consider those economic sanctions we've been hearing about. Russia may be isolated from the rest of the world and have enough reserves to keep their country running for some time, but China, it's a different story. They rely far more on international markets, and the U.S. has a lot more different levers that they can be pulling that would make such a move by China really, really painful. That being said, politicians, they're not always rational. So this risk is one that we've got to continue to watch closely, but we also have to understand it would be handled much differently. Now, in regard to the latter point, the odds of another world war, I would suggest that they're just really small. The reality is leaders today talk a lot more. The alliances, they're stronger. Technology has facilitated education and sped up communication. Globalization has created economic interdependencies between nations and enemies alike. And there hasn't really been a military force like the U.S. in the history of mankind. So simply put, it's hard to answer yes to this question given the short-term memory of the stock market and the lack of really a clear catalyst for a crisis to metastasize and create a significant market event that would be long-term. So on to the second question. Is it going to impact spending? Well, here's the thing. Almost 70% of U.S. economic activity comes from consumer spending. That means when we go out to dinner or when we go to the car wash or get a haircut, that's the economy growing. And if we add in business spending, well, these two represent actually 87% of the $22 trillion U.S. economy. So how do recessions actually happen? It happens when spending slows dramatically. So the second question that we've really got to ask is, will Putin convince Americans to spend less money? And personally, I don't see how we're going to dine out less or cancel our Amazon Prime memberships simply because two countries, all the way in Eastern Europe, are embroiled in an 8-year conflict that continue to fight and start just cause more and more turmoil, especially right now when in the US unemployment's low and there's trillions of dollars in cash sitting in our bank accounts, and masks and travel mandates, they're being lifted as we speak for the first time in almost 2 years. There's plenty of data right now to support my skepticism. For example, let's look at retail sales. In January, it boomed at least 3.8%. It was the fastest gain since March of 2021 and strong across the board. Now, retail sales, it's 30% of the US economy alone. And as we continue to get back to normal, and I hate that term, but as we talk about getting back to normal, it's likely that a lot of that cash sitting in bank accounts is going to be deployed into things like travel and probably entertainment and other services that tend to dominate spending during times of economic expansion. So, what's the big question? This is number 3. Is it worse than what happens in the past? Well, to answer this, let's consider the performance of what we'd consider a balanced strategy, a 60-40 stock bond portfolio. And let's consider that after all of the major crises that have happened over the past 35 years. For example, after the bankruptcy of Lehman Brothers, a big event in the United States, and that was the depth of the financial crisis that we had in 2008, a portfolio of 60-40 increased 4% 1 year later, 12% 3 years later, and 47% 5 years later. The average return after each of these major crises over the past 35 years has been a respectable 1 year 6.4% increase, a 3 year 24.4% increase, and a staggering 5 year increase of 58.6%. In other words, the market's response to a crisis has been quite favorable to investors who remain diversified and patient over that time. The third question that we're really asking is Russia and Ukraine crisis worse than anything over the past 35 years? And I got to tell you, it's hard to see how Russia could inflict as much damage as the financial crisis of 2008, or test America's resolve more than 9/11, or inject the same risk into the banking sector as when the savings and loan crisis almost took down some of the largest firms on Wall Street years and years and years ago. That's why my answer to this question, it's also no. Lastly, it's important to note that while this balanced strategy weathered the turmoil, it had nothing to do with getting out of the market at the right time and then back in just as the madness subsided. We're talking about a fully invested portfolio over that period of time. The success came from preparation, not timing. In other words, it came by building a well-diversified portfolio that was designed to recover from turbulence and grow over time. So, what's the bottom line? Here's some key conclusions that continue to drive our investment process here at Hobart Wealth. Now, stocks, they usually take geopolitical events in stride, and it's unclear how this time is going to be any different than what we've seen in the past. Spending trends, well, they should remain intact, and that drives our economy. The American consumer is arguably in the best financial shape in history, and Putin, he's going to struggle to change that. Typical portfolio exposure to Russia and Ukraine, in most portfolios, it's minimal to nothing. The real risk that we're facing right now as investors, it's inflation. Geopolitical concerns, they come and go. But inflation is a problem for those who don't protect against it. And we continue to adjust our portfolios based upon fundamentals. It's not just inflation, but also a world with higher interest rates. Now, here's the thing. We've been actively preparing for this for some time. The real bottom line is that the economic impact to the United States is expected to be small, and therefore the stock market should reflect this at some point. Our strategy? Well, it remains far more focused, rather than on these geopolitical events, on inflation and rising interest rates, because we view these as real risks, and if they're ignored, over the long run, they could be damaging. So here's to your health, your wealth, and your prosperity. If you have any questions, thoughts, or concerns, please reach out and let us know.